So I'm going to do Colabor Group. Its symbol is GCL on the TSX. Trades about $1.19, $121 million market cap. So it's certainly a small cap in the Canadian market. They are a broadline distributor of food and related products into food service, institutional, and retail channels within Quebec. Colabor is a wholesaler to smaller distributors in the province. Let's look at their historical revenues and gross profit. Well, you can see revenues dropped over the past 10 years from about 1.4 billion in 2014 to about 659.1 million in 2023. We have seen an increase since 2020, so that is kind of the turnaround situation happening, which is good to see. Gross profit, as the business has shifted, has actually improved significantly from about 30 million over the same period up to 119 million this past year. EPS, this is the last 5 years in the trailing 12 months. It's been a little spotty in terms of where they've been. 7 cents about 5 years ago, about 6 cents over the quarter this year. There was a low of around 4 cents during the pandemic. So let's look at recent quarterly and year-end numbers, Q4 and 2023 annual numbers. So solid growth in terms of revenue for the year was around 15%. However, the quarter was a bit of a slowdown. It shows 1.6% quarterly growth. The 2022 period included one more week. So if you factor that out, it was about 5.8% growth on a like-to-like basis. Adjusted EBITDA improved. But again, the margin, although the margin did improve, it is only 5.9%. Operating cash flow, as we see there, it's good. It was up 50%. Let's take a quick look at the balance sheet. We're looking at net debt to adjusted EBITDA. We're less lease liability payments, for the last 4 quarters. It's at about 2.4, up from 2.3 in the same period at the end of last year. We would not like to see this ratio increase significantly, given the fact that the company has a relatively low margin profile. Let's look at the valuations. EV to EBITDA about 7.4 times. Forward-looking ratio 6.8, and the PE right now on a trailing basis is about 23.8. In terms of EV to EBITDA multiple, the company is trading slightly below its 5-year average, but not so significantly that, given the fact that it is a lower margin business, that we would make it close to a buy in our coverage right now, particularly given the leverage on the balance sheet. So I'm going to conclude this. The company just completed a new facility, which is something we are interested in. This is a new wholesale and distribution facility. Completed it in late 2023. This past year, it was about a $15 million CapEx project. The estimates are it can increase capacity about 2 times in terms of revenue over the long term for this company. It is intriguing if organic growth via the new business or the new facility can ramp up into the new facility, but the current valuations, the low margin business, and the leverage make GCL just fair value at present. All right, that's going to conclude it for me.
Yeah, so Colabor, it's been around for a while. I think it used to be an income trust way back in the day, and then it was a dividend payer for a while, and it went through a restructuring.
Yeah.
Way back, the balance sheet leverage was much higher. It's good to see they've got it down to about 2.4 times. I agree with you. That's fully leveraged, though. It's not, I'd like to see the leverage a little bit lower, but it's not horrible. But there's not a lot of space to add more debt on there and keep a strong financial position. But it's a very low margin business. Look just net profit margin.
Just distribution, food services, yes. Whatever. If it's just margin, distribution, right? You're making low margins. Yeah.
5.7 million earnings, I think, for the year off of 650 million in revenue. So less than 1%. So that's really low. I'd like to, it's interesting that they think they can double their revenue capacity. Mm-hmm. But
that is something that interests us, obviously.
Yeah. Because if obviously having a lot of revenue is not their problem. Their problem is driving it to the bottom line. So how does the expansion really do that would be
Yeah,
really
and is that all coming in organically, or do you have to buy that business
hmm
and jam it into your facility essentially? If you're able to organically grow the business into that facility, then potentially you pay down debt with the cash flow, and then you can get to a point where a low margin business might have some interest to us with some good organic growth. But if you have to go out and leverage further to buy other businesses to take their business, bring it into your facility to start bringing up to the capacity up to where you could be, then you're just again getting more into debt. Or if you create cash flow, you're just using that cash flow to buy more business, and the debt still stays on the books. And these businesses don't typically get a high multiple in the market. So when it's trading at 6, 7, 8 times, um, I've seen distribution businesses trade at 2.5 times, right? So you can trade at extremely low valuations. And in our opinion, a 7, 8 times on this isn't a extremely low valuation.
no.
And on an earnings basis, it's still 23 times, which is above the market PE. So
hmm
it's for us, it'd have to be a significantly low PE, a path towards kind of paying off that debt and producing some cash, and then a path towards organic growth upticking. And, I don't think they've proved that out yet. The turnaround does seem to be positive. But if you look at where their share price was 10 years ago, you'll see it has not been executed well over the long term.